Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. President Trump says a ceasefire is now in place between Israel and Iran, hours after Tehran fired missiles towards a US airbase in Qatar. Oil continues its slide as prices retreat to pre-conflict levels. US and European stocks look set to gain at today's open. Plus, Donald Trump heads to the NATO summit. The UK pledges to ramp up defence spending to 5% of GDP, but Pedro Sanchez holds out, saying Spain cannot commit to the target.
In the meantime, a quick check on these markets. It's a risk-on day. A lot of this a reaction to perhaps the ceasefire that is now officially in place, at least according to Donald Trump. And this massive move in oil, Anna, as you point out, a 68 handle on Brent crude now significantly below $70, and the sell-off isn't over yet. Futures, of course, on the other hand, almost higher by 2% on Eurostoxx 50 futures. Of course, the oil story being reflected in the FTSE 100 as well. But risk on when it comes to the euro dollar as well. 116 on that currency pair. The countdown to the opening trade starts right now.
Good morning. The Trump truce is in force. The markets love it. Asset prices are on the front foot. The only question is, does it last? Will Iran stick to it? We've yet to hear from Israel. There are questions that still need to be answered. But for now, it feels this 12-day war is over.
Yes, and that's how the market seems to be interpreting it, and we'll come to that reaction in just a moment. But to go back over some of the details of the last 24 hours then, Guy, yes, President Trump has said that he's negotiated a ceasefire. The White House says that he spoke to Benjamin Netanyahu and the Qatari Emir. J.D. Vance, Marco Rubio, Witkoff, they all spoke to Iran, and that this was the result, what they describe as a ceasefire. Now, we haven't had confirmation from Israel at all. They've been really quiet on this. The Iranians have said there is no ceasefire, but they've no intention of firing if they're not fired upon. And then President Trump, around 6 a.m., so around an hour ago, UK time, said the ceasefire is now in place because the timing was a little opaque as to what exactly everyone had agreed to, according to the US president, and when. So he says it's in place. Before that, in the run-up to that, we did continue to see missiles being fired, and both sides reporting those missiles fired. But I suppose the bigger picture question is, yes, absolutely, does this hold? With oil prices down another 4%, gas prices then substantially lower, it looks as if the market is assuming that it does.
Assuming that it does, it's also interesting, though, that how the GCC is really approaching this as well, because to your point, Israel hasn't actually confirmed it just yet. So there are a lot of countries in the GCC who are still bracing for the potential of another a round of missiles or other attacks.
Trump says it's done. It's done. This is the bit that I find amazing. Why would Israel go against it, for one? Trump obviously has been very much in their corner up until this point. So it feels like the Israelis may say, you know what, enough is enough. What do the Iranians do, I think, is the key question here. Do we get a more asymmetric type conflict beginning to develop? Are we going to see other factors coming into play? I don't know, nor does the market. But the assumption is Trump has said it is over, and the markets are responding as if it is firmly over. There is no equivocation here.
They are. We'll see, won't we? I suppose
exactly.
The question I have is around, nuclear proliferation and what kind of detail. Is there any detail around this? No.
Doesn't matter.
No. So, but in the future, will we be back to talking about this again if the Iranians haven't committed to end their nuclear ambitions?
We need a deal. What do we need to get back around the table? When does that happen? How does that actually unfold? What is the net result of that? Doesn't matter. None of that matters this morning. The only thing that matters this morning is that Trump has said there is a truce in place.
Yeah.
The shooting's stopped for now. Markets love it.
A massive drop in oil prices, though, of course, off the back of it, but also natural gas prices. We saw TCF, for example, trading right at the start of at 7 as well. Oil's now down about 11% in just 2 days' time. But this was the risk, right? The risk was the minute that this conflict is sorted, you do actually have this idea that the oil market is oversupplied at the end of the day. You still have shale producers pumping quite a bit, drill baby drill, but you also have OPEC Plus hiking output for last couple of meetings as well to reclaim that market share. So once you get rid of the conflict and the perceived threat around the energy infrastructure, this is still an oversupplied market. So to come down to earth, it's a good thing for risk assets, but it's also kind of scary because at what point do you start to see this kind of volatility show up in other markets?
Well, I think what was interesting to me was when the markets retreated, when these energy prices came down. And actually, it was very much to do, it was actually just ahead of the Iranian attack against, or toward at least, Qatar. rather than on confirmation of the ceasefire from President Trump, it was actually around the nature of the Iranian response and the sense that Iran has taken the off-ramp with the nature of the response, with the amount of telegraphing it did around the response. And that's what dropped commodity prices, wasn't it? And then it was just compounded by President Trump saying that there's a ceasefire.
Well, it's also negative in our show yesterday. It briefly went negative literally 24 hours ago when we were expecting
it. Was a really muted response yesterday.
Yeah.
There was nothing really in the markets yesterday to signal that this conflict was going to be escalating. In fact, the de-escalation process, you could argue, started first thing Monday morning. You could also argue that Fed speak had a bigger effect on the market yesterday. The Bowman comments, all of the stuff around what is happening with the Fed right now, you look at kind of what the rest of the day now looks like. Is it going to be about the Powell testimony? How quickly do we move on from what happens around the Israel-Iran conflict to other matters? What's happening with the Big Beautiful Bill? What's happening with the Fed story? All these other factors now come back into force.
And even the geopolitical and defence narrative will shift today because we're going to talk about NATO.
So Trump has gone to NATO.
Which was quite a big deal when he announced it.
And does he stay there, I think, is the next question.
Yeah.
So he's gone. Are we setting up for a walkout by somebody? It could be President Trump, quite easily, you could argue. We've got a disagreement that is beginning to emerge between Spain and NATO. Mark Rutte, who is hosting the event. Are we going to see Spain delivering on the 5%? It looks increasingly unlikely. Others may follow as well. I think there is also devil in the detail when it comes to these spending plans. We've now got a 3.5 plus 1.5 plan, right? So you spend 3.5% on defence. Plus, you've got another 1.5, which comes on things like bridges and all kinds of other kind of infrastructure stuff. The problem is, though, that a lot of the budgets that have been put in place over the last few years, that 1.5 has been included in the original target, which was 2%. So now others are going to you're going to have to take all of that out and put it in the 1.5% and actually spend 3.5% on defence spending, which for a lot of people is going to be a struggle. The UK has indicated that it will do so. We've also got this agreement that has been put in place between the EU and Canada, which I think is fascinating. The fact that the Canadians want to buy European, I think, probably signals a lot about what could happen next. But there's so much ambiguity around all of this that Trump could go, you know what, I'm done.
Right, so that could be the walkout we're watching for, whether President Trump does, stays the duration, or whether he's either called away on urgent business, as we've seen before, or he doesn't like what he's hearing perhaps from Spain and others. But even countries, like you say, like the UK, that have committed to this 5% target, at some point that needs to get translated into domestic spending and the conversation back at home, and that's not easy. And there are 2 elections before we get to the date they've committed to of what was it, 2035.
35.
So 2 elections take place before then, and you can't bind future parliaments. So who knows where we end up eventually.
Well, I think it's fascinating as well, because that 3.5 and 1.5 combo is something that's come from NATO, but it's also something that Germany has officially agreed to when it comes to their budget, because there was a thought here, they've now solidified that. The Spain thing I think is extra interesting, because what kind of precedent does it send? They're still talking about spending. They're getting that caveat, and they're saying as long as you get to the same capabilities as the rest of Europe, the actual percentage doesn't matter. But that opens you up for a lot of... Exactly. That opens you up to a lot of subjectivity about what capabilities
Mark
meet
Rutte
that
says
threshold.
that doesn't fly. He says it's the number that matters, and we don't think you can get there on less than the 5%.
Yeah.
And it quite literally needs to fly. That's the problem. This is the debate that Europe is going to have. It's guns or butter. And that's a phrase that goes back a long, long way. But it's, do you service the civil side of the economy, or do you service the military side of the economy? And Europe is going to struggle to convince an electorate that it is going to make that switch. And I think it's going to be really interesting to see how that shows up in the numbers. Mark Sedwell's going to be joining us a little bit later on. He is a former UK national security advisor. We'll get his take on what is happening here. Does he believe that we do see a ceasefire in place? What is his take on the 3.5 plus 1.5 debate? What does he see coming out of NATO? Peter Oppenheimer, Goldman Sachs chief global economist, is going to be joining us. Europe is underperforming. Last 5 days, last month, last 3 months, European equity markets have underperformed US markets. Does that continue? Does today's news continue that? Mark Giannoni, Barclays Corporate and Investment Bank chief US economist, is going to be joining us a little bit later on as well. What does he expect from Powell a little bit later on?
Powell, and how's Powell thinking about the oil volatility that we've seen? There's a lot to discuss with him as well. But as we said, geopolitics are likely to be front and center, at least in the next few hours, as Donald Trump is at the NATO summit officially. The question is, of course, as Guy said, how long does he stay there? There is plenty of other data to keep an eye on as well. At 9 a.m. UK time, the German IFO survey is going to be hitting the wire. 1:30 p.m. UK time, Canadian CPI. This one's interesting. Of course, that's an economy very much exposed to oil prices as well. We're going to keep one eye on that. And then, to your point, all eyes on Powell testifying in the House. Bailey and Lagarde also speaking at separate events. So lots of central banks speak in terms of how to navigate the volatility in these markets and, of course, the uncertainty that could hit the economy. And speaking of uncertainty, what degree of consumer confidence is there in the States? We'll get a read on that at about 3 p.m. UK time. But I think today my tiny obsession is coming to a forefront. The banking decision between BBVA and Sabadell. The government is going to be speaking today, holding a press conference, announcing a decision, I say, at about 1 p.m. Madrid time. That's 12 p.m. UK time. And then a press conference at about 5 p.m. Madrid time as well. And the question here, and we've already got some early leaks of it from Vanguardia, a Spanish newspaper, as expected, that the government is likely, at least from this reporting, suggesting to put on higher hurdles to make this merger happen. The question now is, are those hurdles large enough to disincentivize BBVA from still pursuing this deal?
And I mean, and then it will continue to raise questions about, if we can't do domestic M&A, what hope is there for cross-border? And that's the way this conversation often goes, isn't it?
Exactly.
What do you think?
I think this is not a surprise. I think the other piece of this as well is there's a very key political component to this. One of the key hurdles that Vanguardia is reporting is higher metrics in terms of keeping the labor stay put. So you don't actually remove branches from Catalonia. You don't have that concentration. BBVA is known for their digital banking operations. So a big part of that plea was to kind of reduce branches, reduce the retail branches, and shift to online banking while increasing their Spanish presence because they have more presence abroad than they do in Spain, which is also getting into the government's crosshairs. So if they can address that while still making money on the deal, then they'll stay. But it's that math that we're still trying to work
perhaps
around.
It's not over.
Perhaps it's not over. But lucky for us, after the decision comes, we are going to be joined by Carlos Cuerpo, Spain's economy and finance minister, tomorrow, actually, at 7:15 UK time. So quite literally in about 24 hours, not only talk about his decision around BBVA and Sabadell, but also this NATO spending story and how Spain can actually contribute to this larger fiscal spend theme outside of Spain and in broader Europe. We're going to get his take on that.
Cool. Look forward to that conversation tomorrow. What else do you need to know this Tuesday morning? Negotiations over France's contentious retirement reform ended in deadlock last night, raising the chances of yet another government collapse should opposition parties unite in a no-confidence vote. Prime Minister Francois Bayrou has tasked labour unions and business groups with tweaking President Macron's 2023 law that raises the minimum retirement age to 64. But they failed to agree on workarounds for age thresholds. Bayrou says more meetings with unions are planned for today. Over in the United States, a sharply divided U.S. Supreme Court has let the Trump administration resume rapid deportations of migrants to countries other than their own. The court lifted a judge's order that gave people 10 days' notice and a chance to argue they would be at risk of torture. It's a win for President Trump, whose administration has argued that a Massachusetts court interfered with presidential authority. But it was a split decision, with Sonia Sotomayor accusing the majority of, quote, rewarding lawlessness. And US auto safety regulators are looking into incidents where Tesla's self-driving robotaxis appeared to violate traffic laws during the company's first day offering paid rides in Austin. The National Highways Traffic Safety Administration, the NTSA, says it's aware of the incidents that were captured in videos posted on social media. Tesla has not responded to requests for comments. So that went well. Day one. The stock went up a lot on the back of the fact that this is happening. I guess there are going to be some teething troubles.
Even with that kind of limited, slightly muted by Tesla standards launch. Coming up on the programme, we will take a closer look at the stocks to watch at the open, including, of course, the aviation sector. The Middle East tensions on the back burner then this morning, slumping oil prices, falling gas prices, markets looking a little more risk on. What will that mean for airline stocks, which have seen a big move in oil prices since they closed here in Europe yesterday? Plus, Plus, the Dutch defence minister tells Bloomberg that recent Middle East tensions should act as a wake-up call to boost defence spending. We will bring you some of that interview. Oliver Crook spoke to that minister ahead of the NATO summit. That conversation shortly. But up next, we'll be joined by Raphael Tuin, head of capital market strategies at TKO Capital. Lots to discuss. If you want to get involved in any of these conversations around this desk, IB plus BBTV Go is the function for you this Tuesday morning. This is Bloomberg.
42 minutes in the market open. We now have a response from Israel, from Benjamin Netanyahu, saying within the last couple of minutes that Israel has agreed to the Iran ceasefire. The ceasefire that has been announced by President Trump is now in force, and Israel now the third party to agree to that. The markets respond. Oil is down. Valerie has details.
Oil is down, and it is down substantially, Guy. Take a look over the last two sessions. We're now down over 11% in Brent crude, trading at a 68 handle. This is totally wiping out oil's gains since the start of this escalation on June 13th. The dollar is also weaker. Take a look at euro. It's through 116, and the equity market is really liking this confirmation of a ceasefire from Netanyahu. Over the last two sessions, we're now up close to 2% in the S&P 500. Futures. We're coming very close to all-time highs. We're now around just 1% away from hitting that level. Let's see if we breach it today. But other than the conflict in the Middle East, we also have to keep an eye on central banks. We do have Fed Chair Powell beginning his two-day testimony to Congress today. He will sit in front of the House at 3 p.m. London time. He will release a statement, an opening statement that will go over his view on rates and economic outlook. Likely not to see any surprises there, given he just had his press conference last week. I, for one, will be keeping an eye on banking regulation. This is something that's been heavily speculated by the market, this SLR reform, in order to have banks hold treasuries on their balance sheet with a bit more ease. Also, political pressure. Will these Republican lawmakers sound as combative as President Donald Trump on lowering interest rates? And to that, guys, we just had a tweet from the president just half an hour ago, amping up the pressure on Federal Reserve Chair Jerome Powell to lower interest rates. This time, Guy, he's saying that they should lower rates by at least 2 to 3 points, a 300 basis point cut, something Trump has not called for yet.
Yeah, it's getting interesting, isn't it? We await the arrival of the announcement on the next Fed chair. That is going to be fascinating. Feels like it's coming. How much longer does Trump's patience last? Valerie Teitel on the details of that. Raphael Tuin, head of capital market strategies at TKO Capital, joins us around the table. We'll come back to the kind of the rate outlook in just a moment. Markets are buoyant. Stocks are near record high. Risk is on. Is that the correct response to the environment you see around you right now?
That's actually a good point. Is there a relationship between the reality and the real economy on the one hand and the market reaction on the other? One can argue, especially in Europe, that might not be totally the case. You know, what we do is finance small and mid-sized companies in Europe. The feedback we get is consumer is on hold, very picky about pricing, trading down when it comes to staple consumption. Discretionary consumer is clearly on the sideline for now, and investment is on pause. So doesn't necessarily mean we're about to collapse in many ways, but yes, there is somewhat a disconnect between all-time highs in the market and an economy which is slowing down.
So talk us through this. What are LPs saying? When you go around and have conversations with investors and what they're talking about at the moment and how they're feeling about the world, are they risk on? But what do you say to them when you say, look, the consumer story that we're getting from small and medium-sized companies, we've got pretty good visibility there, is different. How does that conversation unfold? Well,
it feels like a lot of people acknowledge this idea that the economy is slowing down, but there is also somewhat of a muscle memory with investors. Yeah. We've seen it before. To be like not invested enough or to cut on the downside has been painful for performance. There is somewhat of a wait-and-see mode. Some people use the word complacency. That's probably a good word.
Do you use that word?
And we do, actually. We do. Okay. The market is somewhat complacent. We are very happy to hear that the Iranian crisis is now potentially on the sideline for now. But there are some real issues facing the economy and the market in H2. Those are still to be addressed. Tariff, a slowing down in the economy, rising deficit, what's happening with rates, some weird correlation we see between interest rate and other asset classes. All of that still remains, still is at play, and the margin for error at current valuation is extremely thin. So complacency still feels the right word.
Okay, so there's a lot of complacency in some parts of the market. What about in the defence sector, though? That seems to be an area that you have invested in and that others talk about a lot. I was reading yesterday that the value of PE deals in the defence sector globally has increased by 1,700% year to date. I mean, the percentage is that's a sort of mind-blowing use of the percentage. But that just illustrates how much money is going into that sector. Is there more to go?
In our view, yes, that's clearly a strong theme for the years to come, a mega trend in the making. We tend to speak about a ChatGPT moment for defense in Europe. There will be a before and an after 2025. And we feel that this is clearly a long-term trend ahead of us. We have the capacity to look beyond the next few months and really projecting oneself in the next 3, 5 to 10 years. So that's one thing about this mega trend. And with the amount of capital being deployed in the space now, profitability rising at the company's level, we feel there is more performance to go. So very difficult to argue on the short end. Could there be a pause in performance? Potentially, yes. But that's a mega trend as much as, for instance, AI in the US.
Yes, we're heading towards a NATO meeting, of course. We're in one. The preamble has begun, of course. How widely are you defining defence? Because a lot of people are now saying this is going to be crucial industries and all sorts of and securing supply chains. This is a lot more than just strictly defined defence companies.
Yeah, so we just launched this week a new fund accessible to retail investors, and we're defining defense as defense, aerospace, and cybersecurity. Cybersecurity is at play. And when you listen to officials, for instance, talking about defense and budget in defense as percentage of GDP, they are now talking about defense and spending in equipment, up to 3.5% of GDP, but also including cybersecurity as a new theme, potentially rising up to 5% of spending when you look at percentage of GDP. So that's a broad, actually fairly wide area that needs capital to be financed, need investors to participate into this trend, and clearly something you can address through the listed equity market on the one hand, but through private equity as well.
How much of that thesis is challenged by the idea that there is still volatility in these markets? Yes, we're seeing it in oil, but we are still seeing a 11% drop in 2 sessions. There's an expectation that if we go right back to the trade war narrative, you'll see some sort of dramatic drop in, say, bond yields once again, or gold prices. These kind of very violent corrections you're seeing in the public markets. Does that disincentivize these long-term bids?
Yeah, that's really the core of what's happening in the market now, what's going to happen in H2. Obviously, a lot of uncertainties still. We're going to talk about tariff, talking about complacency, this idea that we have basically seen it all, that is going to be, 10% give or take, maybe a bit more for China, some exemptions here and there, but that's it. That's one complacency aspect to it. And then the interest rate conversation is clearly first and foremost something on investors' mind when we talk to people, investors across the world. What's happening with long-term treasuries? What about auction in the treasury market? Are those rising deficits on a sustainable path?
Yeah.
That could be the key in the market. For now, higher interest rates are still manageable for the economy, manageable for market participants. We know there is a threshold from which there might be some effect on valuations, on the cost of carrying higher debt over the long run, and that could be the one key in the market where complacency could stop. So we're not there yet, but let's call it the X factor for investors.
All right. Raphael Tuin, head of capital market strategies at TKO Capital, walking us through some of the thinking there. As he was speaking, of course, we are starting to get more market reaction in response to the headline that Israel's Benjamin Netanyahu has agreed to the Iranian ceasefire. You are, of course, seeing the Israeli shekel, for example, move to a 2-year high, a continued drop in oil as we speak, and, of course, a tick higher when we look at U.S. futures. The idea is simply that now you have all 3 parties, Iran, the United States, and Israel, all agreeing to the ceasefire. We, of course, will see if it holds. But right now, it is a risk-positive mood for the markets. We're going to dive into the details next of what's going on in the Middle East and what to expect moving forward. Stick with us. This is Bloomberg.
Welcome back. 7:30 here in London. This is the opening trade. 30 minutes until we get the start of European equity trading, and a lot has happened until since the last time we saw European stocks changing hands. So the futures picture is going to price a lot of that in. Looks as if we could be substantially higher at the start of trade. US futures are also higher. E-minis up by 1%. Nasdaq futures up 1.3%. Euro Stoxx 50 futures up by 2%. We've had a substantial move in some of these commodities, and we'll be looking to price that into the start of trading. Let's have a look at the bond markets then and see where we are there and see what difference all of this has made. Actually moving in slightly different directions, but extremely small moves, just 1 basis point or thereabouts on the French 10-year. Not a great deal of movement on fixed income. But let's get to commodities, Guy.
Oh, yeah. Let's talk about where the main action is this morning. And it is in the price of crude, and it is the price more broadly of energy molecules. You've got TI and Brent both down by circa 5% this morning. Brent is now trading at 67.99. We have a positively sloping curve now within the Brent market, i.e. spot versus forward. Spot is now below forward, so you have a contango within this market on the 1-year time spread. So that's interesting in itself, in as much as what is the market pricing going forward. TTF, nat gas, is down really sharply this morning in Europe. Remember, a lot of the seaborne nat gas comes through the Straits of Hormuz. It is down by 12.5% in Europe. What I also think is interesting this morning is that gold is softer. Gold is down by 1.3% this morning. As we get the risk on move, you can get risk off into gold.
Absolutely. Commodities as a whole taking a little bit of a beating today. Let's talk about the root cause of that and what's going on in the Middle East. The latest there, Israel's Prime Minister Benjamin Netanyahu says he has agreed to a ceasefire with Iran. Let's get the latest from our Horizons and Middle East anchor, Jumana Bersechu, who's been covering the story out from Dubai. Jumana, does this ceasefire hold?
That is going to be the big question. And let me just rewind back. It's been a really turbulent 12 hours over here in the Middle East. But of note is in the middle of the night, President Trump put out a post on Truth Social announcing that Iran and Israel had agreed to a ceasefire. Now, in the subsequent hours, it was unclear whether both sides had actually signed on to that ceasefire. They continued to exchange blows up until about an hour ago. And about 15 minutes ago, we did hear from the Israeli Prime Minister's office saying and confirming that Israel have now formally agreed to that ceasefire. But I do just want to add a couple of comments here, because they've also said that Israel will respond forcefully to a breach of truce. And if you remember, it's quite similar to the wording of the truce agreement that Israel had in place with Hezbollah at the time when they agreed to ceasefire. It was a ceasefire in principle, but again, Israel reserved the right to still strike back at certain Hezbollah targets should they deem to have contravened the ceasefire. So perhaps we're going to get similar language on that front. The Prime Minister will be delivering a statement later today, but ultimately they are saying that they have achieved their Iran war goals. And as a reminder, their explicit war goals in Iran, and I say explicit, were to ensure that Iran does not go on to have the capabilities to develop a nuclear weapon and to sufficiently diminish their ability to continue to launch ballistic missiles towards Israel. They deem, and this is the language coming from the Israeli Prime Minister's office today, that both of those war goals have been achieved. And so from this point onwards, we'll have to see whether the diplomatic channel can actually overtake, and of course, whether all of this means that Iran will return to the negotiating table with the U.S. and perhaps sign on to some of the more stringent concessions that the U.S. had been pushing for vis-a-vis getting that nuclear deal across the line.
This is the problem. We don't know when that's going to happen. We don't know what the objective of that is all going to be. We don't know whether or not Iran will resist. Is there a sense in the conversations you've been having thus far that this is a temporary ceasefire, that this is something that can hold, that talks will follow?
I think it's very unclear at this point what the Iranian perspective is thinking. Earlier on in the morning, we had a post put out by the Iranian Foreign Minister, Abbas Araghchi, saying that there was no ceasefire agreement, but they had no intention to keep responding to Israeli attacks after 4 a.m. Tehran time. But of course, they did go on to launch a volley of attacks at Israel in the early hours of this morning, and the IDF reporting that they launched 6 volleys in the space of a couple of hours, and 3 people are reportedly killed today. Why is that relevant? Because this is the first number or death count we've seen in Israel in over a week, and the question from here onwards is how readily the Israeli side will be to sign on to the ceasefire in a lasting manner, and equally whether Iran also, from their perspective, are going to adhere to the terms of agreement, especially if they're seen to be aggravated once again from the Israeli perspective. So it's still a very tenuous time, but I think the region as a whole is breathing a sigh of relief that this didn't blow up into a broader regional conflict, and also with that very telegraphed attack that Iran delivered on the U.S. base in Qatar yesterday, which didn't actually lead to any fatalities or severe damage in Qatar either.
Jumana, thank you. Bloomberg's Jumana Basech with the latest there from the region, all the latest news flow from the Middle East. Of course, a lot has been happening overnight and happening quite quickly. Let's get the thoughts of Mark Sedwill, former UK National Security Advisor and somebody with a lot of diplomatic experience all over the world, including in parts of the Middle East. Mark, great to have you with us. Thank you very much for coming in. So fast-moving events overnight, of course. We do then have confirmation from Israel that they have agreed to this ceasefire. Given your experience as a national security advisor in the past, what kind of security advice would you be giving? Would you be urging people to assume that this holds or to be sceptical?
I don't think you can assume that it holds, but of course it is welcome news that it has happened. And as you said, the risk of escalation to a wider conflict across the region has now diminished. It was clearly possible that Iran might have decided to attack some of their neighbors, some of the oil facilities, wider facilities there. This telegraphed attack on the base in Qatar that the Qataris were able to handle using US Patriot missiles has, as President Trump suggested, given Iran an off-ramp to this ceasefire. But the big question now is, as you were just hearing from your correspondent, is what happens next? Iran still has several hundred kilos of enriched uranium, enriched to 60%. The only purpose for uranium enriched to that level is for weapons grade. It's weapons grade material. There's no civilian purpose for material of that kind. That, as far as we know, was not destroyed in the US airstrike. The Iranians said they had secreted it somewhere. It's no longer under IAEA, the International Atomic Energy Authority, supervision. And so what happens to that? And can we get Iran back to the table in order to secure a better nuclear agreement that stops their nuclear weapons program and indeed permanently removes the threat to Israel and the region?
Yes, I think J.D. Vance, the Vice President, has said that he thinks that stock of enriched uranium has been buried. But as you say, the IAEA says it does not know where it is. So that remains an open question. The location of that, clearly something that we still need to get to the bottom of. In terms of Iran's role from here, there's been talk about whether Iran might pull out of the non-proliferation treaty around nuclear weapons, and that would mean even lower visibility of what is happening in Iran. Is that a concern, Mark?
Absolutely. Iran has violated the NPT, the Non-Proliferation Treaty, by enriching uranium to this level. And indeed, that's why the IAEA called it out just a couple of weeks ago, which essentially triggered the Israeli action. So if they were to withdraw, that would mean no IAEA supervision of their nuclear program at all. But even within the NPT, they have been surreptitiously enriching uranium to this level, to this near weapons grade level. And the way this works, I'm not a physicist, but the way this works is that the step from the 60% enrichment up to the 90% plus needed for weapons grade uranium is much more straightforward than getting from the civilian level of enrichment, less than 10%, up to that 60. So they are well on their way, and that's what prompted the action. So clearly, if they do withdraw, there's no supervision of their program, then there's a significant risk that they could race for a nuclear weapon.
Mark, do you believe that Israel has done enough to stop Iran representing a threat to its national security. It sounds like you believe that actually there is the probability that Iran continues, that it has what it needs to get to the next step, and without that much effort. How far away could we be from Iran having a bomb?
Well, Israel has very good intelligence of what's going on in Iran, and Prime Minister Netanyahu has always been crystal clear that he will take action to remove that threat. Including when I was National Security Advisor, and I dealt with him direct. So if he has said that he believes that they have achieved their objectives, at least for now, then they must believe that they have prevented Iran from turning that weapons-grade uranium into nuclear weapons, let alone nuclear weapons on ballistic missiles. And I presume he has the intelligence to satisfy himself about that. We'll hear more from him later today. But in terms of a permanent removal of that potential threat from Iran, that material has to be brought under control, and the weapons program has to be ceased permanently, which means back to the table, back to a diplomatic process, back to supervision of their program.
Does Iran have a viable air defense system? Is it going to remain exposed? It has appeared throughout this process not to be able to maintain air superiority within its own airspace. Is that something you think persists, and therefore, if Israel feels it needs to go back in, it will be able to do so with relative impunity?
Certainly in the short term, it was quite clear that Iran was losing quite badly, this attritional exchange of missiles and drones and so on. They were able to inflict damage on Israel and casualties, of course. But Israel clearly had air superiority over Iran, as did the United States when they carried out that strike. That won't change in the short term. Of course, Iran will try to reconstitute their air defenses in the medium term, perhaps securing capabilities from Russia and China. We'll have to see what they do. But certainly in the short term, Israel, the United States, could continue to carry out any military action should they deem it necessary.
Mark, it's Kriti in London. Just taking a massive step back here, how are you viewing Donald Trump's last 72 hours? Is this a foreign policy win for the second Trump administration?
I think we won't know until we see how this plays out. But clearly, being able to impose a ceasefire, he's always been clear that he did not want to have the United States embroiled in the kind of wars that have beset the Middle East and South Asia over the past 20 years. Took great pride in that in his first administration. And so being able to take action that has clearly damaged the Iranian nuclear program, that seems to have satisfied the Israelis that it no longer presents at least an imminent threat, and then being able to achieve a ceasefire, is something I think he'll take considerable pride in.
Mark, Donald Trump's also due to attend the NATO summit today. I believe he's already on this side of the Atlantic at the moment. What do you expect other foreign leaders, other defense advisors around the world to view Donald Trump's presence there as, especially in the context of the latest in the Middle East?
Well, I think this has reduced the risk of a disruptive NATO summit. Most NATO countries have now signed up to the central proposition that the Americans took to that summit, which is to increase defense expenditure to 3.5% and 5% overall in defense infrastructure and so on. And so the potential for a row at the summit about that has clearly ebbed, because countries have agreed to that. And the president will presumably be there pleased with the achievement of the ceasefire in Iran. It would have dominated discussions, no doubt, at the NATO summit. And of course, he and European allies will now be seeking to resume a diplomatic process to try to put that Iranian nuclear program under permanent control. Of course, Ukraine is still on the agenda. We haven't paid that the same attention over the past couple of weeks because of the crisis in the Middle East, but the war continues. President Zelensky is attending the NATO summit, and so it's an opportunity for him to remind NATO members that that security threat, particularly to Europe continues and to continue to secure European, NATO, American support for his efforts to resist that.
All right, Mark Sedwell, former UK National Security Advisor, with his take on the latest developments out of the Middle East, as well as what to look for when it comes to the NATO summit in The Hague today. We thank you so much. Coming up on the program, Spain set to impose further conditions on BBVA's planned takeover Sabadell. That is according to Vanguardia's reporting. We get more details next on your Stocks to Watch. This is Bloomberg.
Welcome back. It is 7:48 here in London, so 12 minutes until we get the start of equity trading here in Europe. And the futures picture is very green. We are expecting to go higher by around 2% overall on these European equity markets. How high will airline stocks go? How low will oil stocks go? Would be good questions to be asking in around 12 minutes. Let's think about the bigger picture then in terms of the global macro story, how it responds to the geopolitics and the latest developments between Iran and Israel. Let's bring in, for 3 minutes on the markets, our Markets Live executive editor, Mark Cudmore. So, Mark, I suppose oil prices, the very visible sign, or energy prices generally, the very visible sign of tensions ebbing away from this market, down 5% on the Brent price right now. I guess the question is how quickly we get to these lower levels, and is there anything to stop oil prices retreating to where they were before the 13th of June?
I think, good morning, and I think if this ceasefire holds and we don't have another major flare-up, I think oil prices are going a lot lower again in the coming weeks. I think we're going to get back down to probably below $60 very, very quickly. You've got to remember that the macro backdrop going into this was the idea of just excess supply out there and a slightly more concerning demand outlook. Then we suddenly got a big flare-up on the Middle East conflict, which is now disappearing. But we also need to remove the risk premium that was in the price because of Iran's nuclear program, nuclear ambitions, and that ongoing tension. Now that those nuclear ambitions have been set back potentially by years, there should be a much lower risk premium in the oil prices. So expect oil prices to head significantly lower in the coming weeks, and with it probably the dollar too, because what we've seen is the dollar and oil have become much more heavily correlated in recent weeks as people really trade on that idea that the US is the world's largest crude producer and most resilient to a world of higher energy prices. And the other flip side, it is probably least the smallest beneficiary of oil prices really collapsing.
Do lower oil prices mean lower rates? Does it mean lower inflation? Can Powell cut?
I think lower oil prices absolutely mean lowest inflation. I mean, it is the most important commodity in the world. It is the commodity that is the primary cost for extracting every other commodity in terms of the cost of extraction, production and distribution. Oil prices are still just absolutely dominant as a macro input. So lower oil prices is good for central banks around the world in terms of being able to keep rates more limited. Does it work alone to allow Powell to lower rates? No, probably not. And I think there's still too much uncertainty around trade and what's going to happen there. And, of course, the fiscal side. And I think it's going to be a really tense couple of days as Powell is kind of interrogated by congressional committees because he can't commit to rate cuts as much as everyone wants, and he can't say that rates should be much lower, but he has to allow for the option that there's a potential he'll be cutting rates very aggressively later on, just not quite yet.
Well, Mark, if we're going back to the pre-Iran crisis levels in terms of oil, perhaps even in terms of the narrative around equities, why is the bond market catching a bid this morning? What's the thinking for rates traders?
I think in the short term, the comments overnight from a couple of Fed officials saying that they're open to a July cut is leaving traders bet on the idea that Powell will kind of validate those comments at the meeting this week. I think they're surprised those comments came out ahead of the congressional testimony, and there's a presumption that there's some alignment and then therefore they know what Powell's going to say. So I think that's the bet in the short term, and I think there's a risk that they get disappointed. From there, lower oil prices do help yields come lower in the short term. But I expect that yields might be higher again later on this week. But obviously there's big risk either way around the Powell congressional testimony.
OK, yeah, we'll certainly focus in on Powell as we go through this programme and later today. Mark, thank you very much for that. Bloomberg Markets Live Executive Editor Mark Cudmore. But you can get, of course, more analysis from all of the MLive team. MLive Go is the function to use on the terminal. They've been across all of the geopolitical developments of the last 24 hours and how that translates into market action. Let's get to Joe Easton. He's got a rundown of the equities that he is watching this morning. Joe.
Morning, Anna. So energy stocks are set to be significantly weaker today, given the slump in crude prices that Mark was discussing a few moments ago. The important thing for the stocks is where we were versus yesterday's close, and we can see that we are down more than 10%, almost 11% in the drop in crude since the close of equities trading yesterday. So do keep an eye on the big names in Europe: BP, Shell, Total Energies, Equinor. All of them going to be significantly lower according to the broker calls this morning, and then potentially we're going to see it feeding through into airlines as well. That is the other area to watch. Then it's a busy day over in Spain. Firstly, we're awaiting this big decision on the Spanish government's review of BBVA's deal to buy Sabadell, the smaller lender. Now, we have got some reporting out from La Vanguardia over in Spain, and that report saying that potentially we're going to see extra conditions imposed by the Spanish government, including on some of their credit agreements and also consumer rights as well. But we have seen Sabadell rallying over the past year on that deal. Finally, Grifols, also in Spain. This one was a bit weaker in US trading. There's a report out regarding some of the payments made to their main shareholder, also one of their suppliers, and some question marks over that. Now, Grifols denying any wrongdoing in a statement to Bloomberg, and said that the disclosures have already been made to the securities regulator. Keep an eye on Grifols and BBVA in Spain today.
Joe, thank you very much indeed. OK, here we go. 5 minutes to go until the market open. You've got Euro Stoxx 50 futures up by a solid 2%. We are firmly in the green across Europe. London looks like it could be something of an exception. The reason fairly obvious. We see oil prices coming down. Commodities are lower. That's going to feed into names like BP and Shell. But the CAC is up strongly. The DAX is up strongly. The Spanish market is up by 1.5%. As I say, it looks like it's going to be a very solid open for European equities. 5 minutes to go. This is Bloomberg. So a couple of hours ago, Donald Trump declares that the truce is in force, and as a result of which hostilities cease. The problem is that process started actually yesterday afternoon. Once we became aware that actually the Qataris clearly had an early warning that they needed to close their airspace because the attack was going to happen, that clearly things were being telegraphed to the United States from Iran, that an attack was going to be unfolding, then the market basically saw this as the off-ramp. And as a result of which, US markets, US equities took off. Now, Europe captured a little bit of that yesterday, but by no means any of it. No, by no means all of it. And as a result of which, Kriti, we have a little bit of pricing in this morning to do.
To say the least, equities are flying, at least according to the futures indication, a 2% gain when it comes to Euro Stoxx 50 futures, almost 2%, I should say. The FTSE 100 in the green as well, but not by as much momentum, not by as much fervor, Anna. Only higher by 0.6%, but that is very much an oil read-through, as you see oil prices coming down, reflected in the big oil names and some of the metals as well that you're going to keep an eye on. Defense front and center. It is, of course, the NATO summit kicks off today. The DAX flying in response.
OK, yeah, we could see generally, obviously, the picture's going to be risk on, but we could see some divergence between the various indexes based on their sector exposure, and that's where these sectors might come in. We've got oil in focus. Just how weak will the oil majors be at the start of trade? That's an obvious point to watch. We've got oil prices dropping still, down by 4.3%. We've had gas prices in retreat this morning. Airlines, how high will they go? Since European airlines closed yesterday afternoon in their trading, oil prices have dropped by 9%. So there's a big amount of repricing to do there. And banks in the Spanish context, we need to watch those because of that M&A story that lingers. Guy.
OK, here we go. European equities are about to rip higher. Let's take a look at the numbers and see what happens here. There's probably a little bit of a squeeze factor involved. Yes, that's going to be part and parcel of the narrative we're about to see. London's going to underperform, so the fireworks are actually not on the screen. We see London moving 0.2% higher. The oil stocks are where we're going to see some of this weakness coming through. Elsewhere, I suspect it's a big risk-on story. As we start to see that building, the Stoxx 600 is up by 0.5%. We need the other markets to get going and start to trade as well. The IBEX, there there we go, up by 1.5%. The Spanish market moving firmly onto the front foot. The CAC is up by 1.6%. It is also on the front foot. We'll wait for the DAX. We'll wait for the SMI. We're expecting actually maybe these markets to continue that track a little bit to the upside. How high can we go here? What's going to happen a little bit later over in the United States? We're very close, remember, to all-time highs. What is the narrative going to be there? Feels like a very risk-on story this morning. How long does it last for, though, I think is the key question. It's not as if there aren't plenty of other risks out there for us to worry about. So what are we seeing in the sector story? Is it airlines up and oil down? Let's find out.
Well, the airlines are not open yet, so we are actually going to wait for those initial reads and more so that volume to actually show through. But the energy story is very clear, Guy, to your point, and largely an expectation of what we've seen in the last couple of days as well, where oil was the outperformer, and therefore you saw the likes of Shell, BP, et cetera, moving to the upside. This morning, Shell is your biggest decliner, down about a little over 4% as well, but is your biggest weight when it comes to the FTSE 100. Similar story, Anna, when it comes to the Stock 600 as well. Shell, Total, those are your laggards in this market.
Yeah, absolutely. So the oil story is very clear and breaks early. Utilities were a big gainer yesterday as we sought that kind of safety, at least in the early part of the trading day. And that's another sector that retreats then this morning. Interesting, the banks were really weak yesterday, and that's the best performing sector right now. So the banking sector staging an about face on this risk appetite we seem to have rediscovered and waiting for travel and leisure to fully reveal its hand. I mean, some of these airlines weren't down very much. I'm thinking of Lufthansa yesterday, but some of them were down more than 2%. So we'll watch for a bit of a bounce.
Oil is down.
Oil is down a lot.
European carriers generally hedge, so actually you don't see the instant impact coming through in terms of the story for Europe. Airlines like Ryanair are heavily hedged. You are seeing the hotel groups, though. They are open and they are moving to the upside. So IHG is up really strongly. You've got Accor trading up by 6.2% this morning. Lufthansa is now open. It's up by 4.8%, now 5.5%. The stock continues to climb. TUI is open. It's up by 6.5%. So you're already starting to get some big numbers coming through. We'll see how Ryanair, IAG, EasyJet start to open in just a couple of minutes' time. But the early indications are lower geopolitical tension, maybe more airspace becoming available, and a sharply lower oil price, all feeding through into a much more positive cocktail for the airline sector this morning.
We should mention the other sector that's been outperforming in the last couple of days that is underperforming this morning, and that is defense, even in the face of the NATO summit kicking off today as well. If you look at the DAX, for example, Rheinmetall down about 4.2%, but you'll see the likes of BAE Systems, for example, also taking a hit this morning, down over 2%. So we're going to keep one eye on the defense sector and see how that moves forward as, of course, we get more headlines from The Hague throughout the day. Joining us now for a little bit more analysis, Peter Oppenheimer, Chief Global Equity Strategist over at Goldman Sachs. Peter, pleasure to have you on the program. Thank you so much for joining us. We're trying to digest and just reverse basically the narrative of the last 72 hours when it comes to the Middle East. But I am curious about what is the top of your worry list when it comes to maybe going back to the narrative pre-Middle East crisis.
Yeah, well, as you say, this is all very good news, and the markets are reacting correspondingly. But as Guy said, you know, the reaction of the interventions we were seeing prior to that were actually not that negative. And bear in mind that markets have made a lot of progress over the last sort of 6 weeks or so to the upside, and valuations are relatively full. So I think if we're going back to the story prior to this situation in the Middle East, it's really about what kind of earnings growth we're going to get, how is the economic hard data going to evolve, and what kind of valuation are you paying for that. So our view is that, you know, this is very good news for all the reasons that you've been discussing, but the upside at the index level is constrained because valuations are pretty high anyway. And we're looking at positive profit growth, but not extraordinarily strong. I think the action is going to be more within markets than at the index level.
Peter, you use that word valuations, which I don't really harp on because I feel like this market doesn't really trade on valuations, except for it's coming back into the conversation around defense stocks specifically. Yes. And I think this is crucial here because so much of the defense rally in the last 6 months has been baked on promises coming from various European governments. We are now seeing that come to a head when it comes to like Spain, for example, trying to get exemptions, et cetera. Does that undermine the case for defense, or does that just simply make it harder to quantify the move?
I think it makes it harder in the sense that valuation in the end does matter, and these stocks have been extraordinarily strong for good reason. The narrative has been very supportive. But they've appreciated so much, the valuations are reaching levels higher than we see in comparable stocks in the US, for example, which is unusual in Europe because virtually every other sector has much lower valuations than in the US. So I think the underlying story is good, but they've already run so much that people are now beginning to tilt into more value plays. And that's where a lot of the opportunity, I think, really lies in Europe.
When we're thinking about risk appetite, Peter, I wonder where you think things go from here, because we were talking to our colleague on the Markets Live blog earlier on, who was suggesting maybe oil prices retreat to where they were most recent skirmish, and then continue to retreat because there was elevated risk premium about the possibility of some kind of violence between Iran and Israel. So in that sense, could we be in a much more risk-on environment than we were prior?
From that perspective, I think that's right. We've got more supply, we think, coming through. We think there was about $10 or $12 of risk premium in the oil price, and we would expect the oil price to be falling back, to around $60 by the end of this year. And that does support the prospects of more inflation moderation, interest rate cuts. And that would be good, I think, for sectors and companies that will benefit from a lower interest rate environment.
And is that going to move the dial for European growth, do you think? Because I know that when you speak to investors, you've been quite recently been hearing, sure, Europe sounds more interesting than it was, but there's still a growth challenge. Does a weaker oil price move the dial there?
Not significantly. I think we're looking at positive growth in Europe, but not spectacularly strong. The opportunity, I think, is much more about the diversification. And a key question here is whether the dollar resumes its trend of moderation, which we think it will over time, and we get, again, the incentives to diversify away from very, very high dollar exposures, which most investors have built up over many years. And I think Europe fits in very well to that diversification opportunity. It's cheaper, there is positive growth, and there are a lot of opportunities which look comparatively cheap, particularly when you look at them in dollar terms.
Can we just talk about Europe for a moment in a bit more detail and talk about some of the numbers? So the last 3 months, Stoxx 50 is down by 1.71%. I'm putting this in. We can currency adjust in a moment. The S&P is up by 4.5%.
Yeah.
It's a similar story if we look at it over the 1 month period. The US has outperformed. If I look at it in the last 5 days, the US has outperformed. Yes. Have we reached the point where actually the bulk of the European trade is in and that outperformance period has come to an end?
It's a good point, but obviously it depends on where you start your comparison. I mean, if you look at it year to
last
date,
3 months, okay.
Europe is still outperforming in local currency terms and quite strongly in dollar terms. And I think that's the start of the point from which people have maximum confidence in US exceptionalism coming into this year, confidence in dollar strength, in US and US tech outperforming. And since then, we've seen a moderation of that enthusiasm and a desire to get more broad exposures across different markets, across different themes and sectors. And I think that will probably reassert itself. So I don't think it's likely we see significant outperformance of Europe or other markets relative to the US, just a broadening out of the opportunity set and more focus really on alpha than beta.
Are you getting that from... Who is doing that? Is it US investors? Is it European investors? Is there a difference now in terms of domestic bias versus international bias in the United States? Because if you can take the dollar out, it doesn't really matter. As much for a US investor.
Absolutely. But I think we're seeing two things. Firstly, European investors have accounted for more than half of the net inflows we've seen into European equities this year. So European investors are, at the margin, bringing some money back to Europe because they can see some better opportunities. And also, they're looking at dollar-based investments that are potentially losing money from a currency adjustment perspective. I think that the point that you make about the US is a very good one. Retail investors have been aggressively buying the US market. The leading stocks, the big tech stocks, have had remarkably strong earnings growth again, and they've accounted for most of the rebound in the US market, and for good reason. But again, a lot of asset allocators in the US, a lot of global investors are looking at the potential to get better risk-adjusted returns by having a broader spread, partly because I think at the margin they are beginning to think the dollar has potentially further to decline.
I've seen a couple of calls from various Wall Street banks that are now, to Guy's point, neutral on U.S. equities, some even underweight, but still overweight on large-cap tech stocks. Is that a plausible thing? Is that a plausible divergence that you can really separate out the tech story from the broader S&P 500?
I think it's difficult because of the scale and size and weight that these companies have. I mean, the biggest 5-6 companies account for nearly a third of the index again. They are very defensive because they have strong balance sheets, they have a lot of cash, and they're extremely profitable still. Now, you can question the future relative growth rates, which may be slowing as they ramp up capex spend and you get some more competition and the market broadens out. But I think they're still a very, very crucial driver of the US market, and we think the prospects there remain good.
A number of people that have been on this show, in that show, over the last 24 hours think the market is complacent about the risks that it faces. Do you agree or not agree?
Yes, I think there is a degree of complacency. When you think that, US equities, for example, are trading at around 22 times earnings, that's well into the 90th percentile of historical comparison. Even Europe, which is a lot cheaper, is trading at 65th percentile or something like that. Now, I think there are good reasons for that. But when we used to talk about there being no alternative to equities as an explanation for why they're expensive, that's less true now with interest rates higher and bond yields higher. So this isn't, I don't think the downside risks are very significant. Private sector balance sheets are strong, interest rates can come down. But I think the scale of upside at the index level is more moderate now than we've seen for some time. And I think that, there's relative complacency for things that may go wrong.
Peter, it's always great to see you.
Thanks
so much for coming to see us this morning. We really appreciate it. Peter Oppenheimer, Chief Global Equity Strategist, joining us from Goldman Sachs. Joe, what do you got? What does the Core 6 look like? Let's start with that, and then we'll come to you. This is the picture at the moment. We have a Core 6 that is broadly positive. As you can see, some real outperformance coming in the middle of the pack, actually pretty much across the pack. The only underperformer is Nestle, the defensive stocks, doing less well this morning. Elsewhere, you are seeing some significant weakness in energy. Joe, what do you got?
So we have indeed, Guy. We've got some significant red on the screen for the oil stocks. These oil stocks, most of them falling the most since April when we saw Trump announce those tariffs that sent those shockwaves around the market. So BP down the most since early April, down around 6%. Shell coming down 4% as well. Total Energies, all of them. Equinor also weak as well. The oil price decline dropping more than 10% since the close of European equities trading yesterday, and that feeding through significantly into the market today and then into the airlines as well. IAG, that one is headed for its biggest gain in more than 2 years. So since October 2022 is the last time we saw IAG close up 7%, and also Lufthansa, Air France, EasyJet down in the short haul. They're all getting a big boost today. And then the other sector in focus, of course, is defence. Now, we did see a drop in the sector yesterday, mostly on concerns around whether the NATO summit that's going on this week will disappoint in terms of spending. But another weekday for the sector. So this is kind of a two-day move, given the headlines we've got overnight. Therefore, we're seeing Thales, BAE, Saab, all of those stocks sliding against a two-day drop for defence, given those headlines. Then we've got Grifols in the single stocks. Now, a report yesterday, as mentioned earlier, around the company paying money to some of its shareholders. That was a supplier as well, and question marks over that. So the stock only up 0.9% at the moment. That is probably helped by the broader positivities. That would probably be weaker, but it is a significant underperformer. As I said earlier, Grifols did deny any wrongdoing in a statement to Bloomberg. Then another single stock to bring you is AstraZeneca, some drug trial updates from last night. The lung cancer drug, the latest one, getting a positive read, but only up 0.6%. Potentially the defensive shares actually underperforming, so people going for the more risky stocks today. But Astra up very slightly today. And then finally in the car space, BMW, an underperform at BNP Exane. Now, Exane saying that the margins at BMW are going to collapse in the next couple of years, given the weakness coming over from China in terms of EV competition and also the tariff issue. But the stock managing a 2% gain because everything is up today, even stocks getting downgrades. BMW up 2% over in Germany this morning.
Thank you very much. Thanks to Joe Easton from our equities team for the briefing on those stocks. And as he said, almost all sectors in positive territory then. Only energy and utility stocks in retreats. And linked to that, of course, coming up, oil tumbles as a ceasefire between Israel and Iran takes effect. We'll find out what's next for oil. This is Bloomberg.
Tuesday morning, decent bounce for European equities. We are 18 minutes into the session. The Stoxx 50, the Euro Stoxx 50 is up by 1.7%. London is underperforming. You are seeing some of the oil stocks obviously coming under pressure today, which is interesting. Some of the defence stocks actually not doing quite so well. Where we are seeing significant strength, of course, is within the airline space this morning. You've got a number of names popping sharply high. Some of the biggest moves we've seen in years coming from names like IAG, Air France, Lufthansa, some of the low-cost carriers around Europe as well, benefiting from that lower oil price story. The long-haul carriers also seeing a benefit maybe coming through from less tension, meaning better operating environments through the Gulf. Benedict Campbell, who leads our global aviation coverage for Bloomberg, joins us now from Berlin. Benny, I'm assuming the bulk of this is the oil price move to the downside, but some of it must be just an easier operating environment as well, potentially for some of these big global carriers.
Yeah, and it's, you know, in some ways aviation is driven by sentiment, and the sentiment now is relief. And there's a sense that, you know, this was a short scare last night when Qatar closed its airspace, and that really escalated the situation on the ground, or in the skies rather, I should say. And the fact that this was short-lived, we're sort of back to normal now. There's a sense of normalcy, and maybe even more that now we might get a ceasefire between Israel and Iran. So there's broadly a sense that things are looking up. And that always is important for the aviation industry. It's, as I said, sentiment-driven. People want to feel good about booking that next flight, getting on the plane, feeling safe about it. And yes, as you say, the oil price falling, that's obviously a big tailwind for the industry. Oil or kerosene is their biggest cost. So if that comes down, that helps. The airspace reopening, that means shorter routes or more direct routes. So all of that combined really shows why the stocks are up now.
This sector is important for airlines everywhere, but sorry, the oil price is important for airlines everywhere, Benny, but in particular in the region, really interesting that so many economies have been diversifying, trying to diversify away from energy, and tourism and aviation has formed a part of that. How do you think they'll be assessing how the aviation sector handled this?
Well, yeah, I mean, one thing that the aviation sector has done is not responded in a uniform way. We've seen some airlines come out very early and cancel some flights. You know, last week, I should say, we had American Airlines, we had British Airways cancel some flights. And really the local carriers, the Qatars, the Emirates, were really the holdouts and maintained their service throughout the region. And so not a unified response, sort of back and forth. And something we saw yesterday as well. You know, Qatar closed down its airspace after they got word that there might be an imminent attack on that US base. Emirates maintained its service throughout the night. There was a brief interruption, but broadly speaking, service was maintained. And that's really a picture that we've seen across the industry, that there is not one sort of single approach. It's sort of country by country, airline by airline. For this region, it's obviously a very important industry. Qatar and Dubai, those are two destinations that have really built big parts of their economy around the aviation sector, really sort of global super connector hubs that they've built there. So any disruption there will be acutely felt, and that's what we saw yesterday, and that's why there was this big scare.
Bloomberg's Benedict Campbell walking us through some of the read-through into these airline stocks. We thank you so much for breaking it all down for us. In the meantime, of course, let's go back to the oil majors as well, because if you are looking for a laggard in this market, that's where it is, really magnifying the experience that you were seeing when it comes to the oil price move. Of course, it's down, like I said, some 11% over the last two sessions. That's translating to somewhere between 4 and 5% move for some of the major oil companies in this region, of course, holding back the FTSE 100 from the pretty substantial gains you're seeing in the other European indexes as well. Bloomberg's senior executive editor for energy and commodities, Will Kennedy's all over this story. Will, so we know that oil's retracing. They're getting risk of that geopolitical risk premium. That's no surprise there. Once it comes back to whatever it is market calls fair value, what is the next driver for oil markets?
I think we should note that it's been the week is probably sort of not more than 24 hours old, and we've gone from 80 to 68. So it's been a pretty wild start. And I think what that tells you is, when I was here yesterday, we talked about that geopolitical risk premium of $10 in the price. That's gone. You know, the market has made up its mind that this crisis has passed. And to answer your question, Kriti, it's now focused on what it was focused before this crisis erupted, which is the supply-demand balance and the likely oversupply that we see in the second half of the year as OPEC Plus continues to add barrels to the market, as we get increased production from non-OPEC producers. And I think that, people will be focused on this sort of range in the low 60s.
But does the range get bigger? You've got the kind of the geopolitical risk that kind of takes us up to here, but now you've got this oversupplied market which takes us all the way down, you could get into the 50s quite easily. So are we going to see bigger oscillations within the price of crude? Does the range get larger?
I think that really depends on the geopolitical situation. I think on a supply-demand fundamentals, I think this is the range that people saw beforehand, the sort of 60s, low 60s, will pertain into the future. I think that what took us into the 70s and even higher for a brief moment was this geopolitical crisis in the Middle East that no one had seen coming quite so quickly. I think what's important to the market geopolitically is this was a scenario that people had talked about for years as a massive risk to the oil market, that there would be this conflict between Iran and Israel, and the US would get involved. And we've had that, and it's been a dog in oil terms that hasn't barked.
Right, so does that mean we should go lower than the middle of June prices then?
Well, it's an interesting question with this risk out of the market, with traders thinking that geopolitical risk isn't so much there. It's a good question, and it may be that the market tries to test some lows here and see where the bottom is. We will have another OPEC decision at the beginning of July, in that first weekend of July. The expectation is that they will put an extra 400,000 barrels a day into the market. I suppose one thing people will focus on is, A, will that definitely happen? And B, is there a risk that the Saudis will push to go faster still? But that 400,000, I think, is the market's base case right now and probably priced in at this juncture.
A final question to you on the volatility, though. To your point, we've dropped like $10, $12 in the span of a very short amount of time. The last time we saw that kind of move in that short amount of time was Liberation Day. But before that, it hasn't been that often. What kind of risk does that present for investors who are trying to trade that geopolitical volatility, that you could, I imagine, lose a lot of money very quickly?
Yeah, I mean, look, it's been an incredible trading opportunity for a lot of people, and clearly some people have got caught out. Some people are going to have made an awful lot of money, which we might find out about in the coming weeks. I do think that it's been one thing that we might want to think about from here is it's probably been a very good opportunity for the shale industry to hedge. So I think you're likely to have seen, and we'll try and report this out, some shale producers covering their downside, which may give a little bit more support to US production over the second half of the year.
That's even more crude coming in.
Yeah, absolutely. Yeah.
They were reading President Trump's commentary, perhaps, about the importance of keeping it flowing.
Absolutely. Well. I mean, but clearly US production will be something the market focuses on the second half of the year, how quickly it plateaus, whether it can continue.
Well, thank you very much. Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. Coming up with a tentative ceasefire in the Middle East. We'll talk about where the US economy goes. We'll also be focusing in on Jerome Powell, who speaks later, of course. This is Bloomberg. This is the opening trade, 30 minutes into today's session. So far, looks pretty risk-on. All of this because of the ceasefire announcement that we've now had confirmed from the Israelis. And we see stocks are going higher, in particular travel and leisure stocks. So oil prices are significantly weaker. That means airlines go higher and energy stocks come lower. So energy and utilities, the two areas in negative territory. But overall, we rise. Kriti Gupta has been digging deep for some further intelligence around the energy markets. Kriti, what have you got?
Well, it's a fascinating 48 hours when it comes to these oil prices. And I just want to put this into context here, what we're actually seeing, because a good chunk of the positioning that we've seen going into the upside in oil in the last week or so has actually been driven by smart money, by the hedge funds. I think this is really interesting. We're looking at CFTC data as of June 17th. We're getting a fresh set of data later today in the U.S. session. But really what you can see here is this massive move upwards in terms of long-term exposure to Brent crude. So in the coming days, as we see this retreat in prices, really keep an eye on who's getting hit, who's actually made money on this trade. And that's going to be crucial because this next terminal is going to show you exactly what has just happened in this market. Not just a price retracement, but actually going back to contango, an oversupplied market, which is is what this entire red piece of the market is showing. Excess production from U.S. shale producers, more production from the OPEC Plus story, not to mention prices coming lower and lower simply because of that trade volatility and other geopolitical risk around the world. This spike, though, is what you've seen in the last week or so when it comes to that risk around Iran and the strikes there. What is the potential closing or worries around a potential closing of the Strait of Hormuz? You can see that is almost now right back to flat, right back to where we're headed in terms of contango territory. But, Anna, there's a very clear read-through into the U.S. economy here. I mentioned the shale production. We just had a conversation with Will Kennedy of our oil team, talking about the fact that shale producers likely took this opportunity to hedge to the upside, really locking in those prices for some of the production that they are going to be pulling down the pike. This is also coming in the background of a little bit less production from the U.S. because of those lower oil prices. And this is the Baker Hughes rig count that really shows you going all the way back to 2021, 2022. You start to see this risk sentiment, a lot of production here. But in the last couple of months, you've actually seen a pretty decent drop when it comes to the rig count. And, Anna, that's just yet one more element of a bear story when it comes to oil, one that affects the entire American economy. 8% of U.S. GDP is exposed to the energy sector. 5% of jobs comes from oil and gas.
OK, nice place to start our conversation with our next guest then, Kriti. Joining us now, Mark Giannoni, who's Chief US Economist at Barclays Corporate and Investment Bank. Joining us now on set. Mark, a lot to talk to you about. The role of the energy sector. We'll look ahead, well, the role of the Fed, and we'll look ahead to what Jerome Powell might say later with that in mind. But if I start with the energy sector, I mean, Kriti was just talking there about the exposure of the US economy in terms of the percentage of GDP maybe, or percentage of jobs that are attached to energy markets. How important is this retreat in oil prices, do you think?
Look, I think we bring, as Kriti showed just a minute ago, we bring the oil price back to where it was a few days ago. I mean, we've seen oil prices dip since the end of March, pick up again with the uncertainty that we had of late, and now come back down over the last 24 hours or so. I think this short-term volatility doesn't do too much for the macroeconomy at large. I think what we are looking at is some oil price volatility associated to the Middle East. But in terms of the effect on the economy as a whole, it has maybe some effect on headline CPI inflation, but not so much on the core inflation and not so much on activity anymore. Actually, less effect on activity now than it had about 15 years ago when the U.S. was not as dependent on the oil sector.
OK, and we're going to hear from Jerome Powell later. He's going to be questioned, quizzed on his monetary policy stance. No doubt this will feature. You know, people might be saying, come on, Chair Powell, oil prices are much weaker. Surely there's more space to cut rates. But the arguments he was making last week were really around tariffs, weren't they? And around the lack of certainty and lack of clarity that we have, and his expectation that some of this will stick to the consumer, prices will be passed on. So what kind of messaging do you think we're going to get from Powell later?
I think we'll have a repeat of what he said during the press conference, and also what we heard him say with even greater concern at the May press conference, when at the point where tariffs were so high, we had tariffs on China, let's say above 150% or so. So since then, tariffs have come down. Chair Powell told us during the press conference in June that the uncertainty to some extent had come down slightly since then. But I think the Fed and Jerome Powell in particular are quite concerned about a rise in inflation coming. And they want to make sure that the bump in inflation that we are going to get related to the tariffs is not going to translate into a more persistent inflationary pressures.
If Bowman was the next Fed chair, if Waller was the next Fed chair, would they be cutting rates by 200 or 300 basis points?
So we've heard from these two governors that they favor fairly rapid rate cut if price pressures do not show up related to the tariffs. Now, this remains to be seen if these price pressures are going to be as muted as they describe in this scenario. We expect price pressures to build up in the next several months, and to see these monthly increase in core CPI, core PC inflation to start firming and increasing over the next several months through October. But in any case, even if they wanted independently to lower rates, I think it's going to be difficult to convince at least half of the committee. What we saw from the dot plot last week is a very divided committee at this point. As Chair Powell said, maybe not with as very firm beliefs, but with clearly two camps there, with one camp wanting to keep policy on hold.
Okay, so as soon as he announces the next Fed chair, A, do I ignore Powell from then on? Is he a lame duck? And B, is that when the fight really erupts on the FOMC between the cut, no cut kind of camp? How bitter does that fight become in terms of how you see things unfolding?
So first, I don't think he's going to be a lame duck until the end of his term as a chair. For one, the chair has enormous power, has the ability to direct the staff to do work, to provide all the information to the other governors and FOMC participants. The chair is the one organizing the meeting and bringing the committee to a decision or to a consensus. So I think he has enormous power as long as he is in the seat. And people can speculate about what may happen after his term is over, but while he is in the seat, I think he has a tremendous amount of power. So that's the first point. Second, I do think that it's a committee decision ultimately, and if some members want to proceed differently, they'll have to convince the rest of the committee.
Sure.
And that's going to be quite a challenge.
How much of the work for the Federal Reserve is the bond market doing in terms of the volatility that we're seeing? Is that enough to do some of the cooling that perhaps the Fed is trying to do?
So I think the Fed, through its policy and its communication, is trying to have the longer-term rates do the work for them. So that's a very important factor. Now, the further away we look at rates, the harder it is for the Fed to affect them and to control them. But they do, longer-term rates do a lot of the work. And so that's why Fed participants tend to look at broader financial conditions at large. So 10-year yields, 2-year yields, 5-year yields, as well as, equity markets and the exchange rate, of course.
Mark, let's talk about the big, beautiful bill. Let's talk about this deficit. There may be a breaking point coming this summer as soon as next month. I'm realizing we're in the summer now. Give us your doomsday scenario. What happens if the debt ceiling isn't raised, if we do come to that disagreement in Congress?
So, I do think a debt ceiling will be raised and needs to be raised in order for the payments, all the payments to be made by the federal government. I do think we'll get to an agreement. Our baseline is that we'll have maybe a little more stimulus than, we'll have the tax rates, at least the TCJA being extended by the end of next year. So the tax rate continuing at the current value so that we won't have this break on the economy by the end of this year onto the economy next year. And we'll have to have debt ceiling being raised sometimes during the summer.
Very quickly, can you just tell us about the ripple effect that may come when we talk about if the tax story isn't extended? How much of a hit does the economy take?
So if we do have the tariff increase and we don't have an extension of the TCJA, I think we are looking at a pretty significant hit in 2026. Not so much this year, but in 2026. Again, we don't think this is happening because there's a lot of support in government to extend the TCJA and ultimately in the House, in the Senate, as well as with the president. So I think we are likely to have that.
All right. Mark Giannone, Chief U.S. Economist over at Barclays Corporate Investment Bank, giving us his take, of course, ahead of Jay Powell's testimony in the House later today. And, of course, how we talk about these oil markets in response. We thank you so much. As he was speaking, we did get some headlines from the IDF saying that they've identified missiles launched from Iran toward Israel. Sirens are sounding in northern Israel. Now, we should caveat this by simply saying we don't actually know whether or not this is a breach of the ceasefire or simply a late message. We are still trying to work that out. But the initial comments coming from the IDF seem to be having a small market effect here, where we are seeing Brent crude tick higher just a little bit. We are seeing futures, at least in the States, reverse and tick higher in the dollar as well. We're now looking at a slight retracement when it comes to euro dollar and the pound.
Just goes to illustrate how nervous, how jittery markets are, still watching, perhaps trusting in the ceasefire, but also just watching at the margin for any threat to it.
We don't know what missiles there are, we don't know what the flight time is, we don't know when they launched, we don't know there's a lot we don't know here. I think we probably just need to caveat all of that. We will come back to it when we get more information. I think probably is the narrative that we need to be watching out for. Can European leaders convince President Trump to commit to NATO and the continent's security? How much do we have to spend to make that happen? How much will Spain have to spend to make that happen? We're going to take you to the NATO summit. It's happening in The Hague today. We'll be there in a moment. This is Bloomberg. Welcome back. 45 minutes into the session. Sirens are sounding in Israel right now, as a result of which we are seeing something of a softening in terms of risk sentiment. Not by much. Let's just bear that in mind. You did see a gap higher first thing in terms of equities here in Europe. We've softened up just a touch. You're seeing a similar story when it comes to what is happening with the crude market, which is down sharply. A little bit of firmness maybe creeping back into that story as well. We will watch with interest to see how the sequencing around this latest attack has happened and whether or not it came after the White House imposed the deadline on the arrival of this ceasefire, Anna.
Yes, absolutely. Let's stick with the defence theme. Donald Trump heads to a NATO summit in The Hague today on the back of the surprise ceasefire that he announced in the Iran-Israel conflict. The president arrives amid concerns about Washington's commitment to NATO. The Dutch defence minister told us the United States is committed to the alliance.
What I heard so far at every meeting that I had with my American colleague or any plenary meetings with a larger group of countries, whether it's Secretary Rubio or Secretary of Defense Pete Hegseth, they all say that they are committed to NATO, that NATO is more relevant than ever, and that Article 5 remains a fundamental pillar to our transatlantic security. I think that's the foundation, and that remains solid. Of course, we need to keep discussing with the United States what military assets, how many troops they want to have in Europe. It could be that some of those resources will be shifted. I think that's quite likely that that's going to happen. But if we can do this in coordination, and if that happens gradually, and if the foundation still remains here in Europe, I think that's something that we can overcome. If we agree to 5% spending on core defense and on defense-related matters, I think that would be an historic step. If you go 1 year back to the NATO summit in Washington, D.C., what we agreed upon is that the 2% is not a target, but it's a floor. So we are now 1 year later, and if we now move from 2% to 5%, with, of course, a 3.5% and a 1.5%, I think that would be an historic step, especially if 32 allies in unity agree on this. I think the rules are the same to everyone. I also think that Spain will sign the declaration on Wednesday when the NATO summit comes to an end. Of course, the reality is that countries have flexibility in the way that they implement these agreements. And that has been true in the past as well. In 2014, we agreed on the 2%, and many countries only this year reached the 2% or still have difficulty reaching it. So there is some flexibility in the rules that NATO sets, and it's both on the financial side but also on the military side. But I think in the end, what it comes down to is that we all agree on the same percentage, that we do have military plans that were already agreed upon 2 weeks ago, and in which every country said, I'm willing to do my fair share. And I think that that's key, and that's as relevant for Spain as it is for any other country.
The Dutch defense minister speaking to our very own Oliver Crook in The Hague, talking to us about that defense spending story. Oliver joins us now from the ground. Ollie, talk to us about that 5% level. How much of the narrative has Spain changed?
Yeah, so listen, Kriti, this is the sort of big, beautiful number that NATO leaders here would like to present to Donald Trump. We know that the U.S. administration likes to have big, clear, clean easy to understand wins. And when we think about what NATO is now committing to, which is what we understand they will all commit to spending 5% of their GDP on defense, you have to imagine how long a road this has been. In the last 6 months, I think in the last 6 months ago, it would have been inconceivable to think that NATO members would sign up to 5% defense spending. That has really been the product of the pressure that has been exerted by the Trump administration. Now, we should say there's a little bit of devil in the details. About 3.5% of that 5% is really that sort of core defense spending on things like guns and ammunition, tanks, all of that sort of thing. 1.5% of that is going to be more on sort of ancillary defense adjacent things like cybersecurity support. And let's imagine a situation where, you know, there is a war on the eastern flank of NATO and all of those tanks and heavy equipment need to move across the continent. So you could spend that 1.5% on, say, infrastructure roads in order to make those things move across the continent. That is sort of the fudge there. The real sort of other issue is the question of the timeline. They're going to commit to this target for 2035. So that is a long runway to reach that target. That is not really going to please the eastern flank of NATO. That has been some of the debate. But again, that is part of the concessions that have been made in order to get to that 5% figure. But again, of course, the last sort of fly in the ointment is the fact that the Spanish, Pedro Sanchez, the Prime Minister of Spain, has at the sort of very last minute said that they sort of object to getting to spending that much money from the Spanish side. They say that they can reach their NATO targets in terms of capacities by spending only 2.1% of GDP. This has been one of the open debates. And then we heard from Mark Rutte yesterday saying that he really doesn't believe that Spain can get there with only 2.1% and that really everybody in NATO needs to commit to that 5% target.
So, Oliver, what's the worst case that happens here? That the Spanish don't come on board, it inspires others to rebel, that President Trump doesn't like what he hears and he walks out? What are people thinking about?
Yeah, that would be certainly the worst case scenario. If you cannot have agreement among the NATO members in order to hit that target, Trump either does not show up to the meeting or does, and there's a sort of spectacular brawl of some kind and breakdown. And basically the idea that Article 5, this concept in NATO, that basically an attack on one is an attack on all, that the United States steps away from that. Of course, that has been the sort of threat from the Trump administration through the years. That would be the sort of worst case scenario. But Anna, if we take this to sort of the best case scenario, what is that? That basically all of these NATO countries agree to 5% spending. They agree to a reasonable timeline. They agree to spend it mostly on United States kit and hardware because that is the biggest provider of all this sort of stuff. What is that going to do to Donald Trump? Is he really going to do a 180 and basically have a warm embrace of the NATO alliance and be very happy with all of the countries here? Probably not, right? He's still probably going to draw a pretty hard line. So for these NATO members, I think the 5% is almost a sort of minimum target to keep Trump broadly on side. And the other thing that hangs over this meeting is this question of American troops within Europe. There are about 84,000 American military personnel spread all across Europe. About 40,000 of those are in Germany. We know the Trump administration does not want to be concentrating its military forces in Europe. They need to look more to Asia Pacific. They obviously now have this conflict in the Middle East. They're going to look at probably reducing those ranks by the tens of thousands over the next couple of months. So this is all part of the conversation here. And we should say, just as a final point, that for the Trump administration and Donald Trump, whatever you may think of him, whatever many of these leaders may think of him, this is one of the great policy goals that he has set out to get the European spending on defense. And there's no way of debating the fact that he's been intensely successful at getting that done.
Isn't this whole thing just going to be a victory lap for Trump? It just feels like that. He's coming off success in the Middle East. He's just achieved a huge aim in that theatre. He's persuaded the Europeans that they probably need to spend more. Yes, there's going to be some shuffling of where that spending comes through. But isn't this just going to be a massive victory lap for him?
And I think it also puts into focus how kind of irrelevant on the geopolitical stage many of these European countries have become in the absence of the multilateral, G7 order. We saw it from the meeting last week in Canada. It's more of a sort of G6.5. If the Europeans aren't joining their voice to the United States and if they're seeing things more and more differently, what sort of relevance do they have on the global stage? And Guy, precisely to your point, I mean, there was some doubt about whether or not Trump could show up here if this situation with Iran was ongoing. He now arrives here a little later this evening with a big win under his belt. And basically the question is, does that put him in a good mood? Is he going to be nicer? Or is this just going to embolden him and say that basically whatever he says goes and he can continue to sort of push around the Europeans a little bit more? That is going to be sort of an interesting thing to watch over the next 24 hours.
I am assuming that the ceasefire in the Middle East holds. That's something that we don't quite know yet. Ollie, great stuff. Thank you very much indeed. Oliver Crook joining us from The Hague. We've got some great coverage coming up from the NATO summit this week, including the foreign ministers of Germany, Latvia and Lithuania, all joining Oliver Crook at that event as we work our way through this NATO summit. we don't know yet whether or not the ceasefire holds.
We don't know whether the ceasefire holds. We heard earlier that there were some headlines or some messaging coming from the IDF that there were potential sirens and expecting some sort of missile barrage from Iran. Again, we don't know if that is a violation of the ceasefire. We are getting comments, however, from Israel's Defense Minister Katz commenting on the Iranian missile launch. It's unclear if he's commenting to the latest one or the one from previous iterations, saying they've instructed the IDF to respond forcefully to Iran. We should also mention, at the same time, we're getting headlines from Iran itself when it comes to their production program. This is coming from a semi-official mayor citing the nuclear chief, Eslami, saying that Iran plans to avoid interruption to production processes and is assessing their damage to nuclear sites. When it comes to the market reaction, Anna, we did see a teensy, emphasis on teensy, move and kind of in reverse.
I don't hear that word very often.
No.
You're welcome.
It just did.
Quite small.
Quite small. Teensy.
Quite small. Yeah, the
We'll
market
see.
is just nervous. The market is really nervous, isn't it? For any clues, any signs that this ceasefire does not hold, we will have to wait and see how these things develop. This is something that is very much on the market's mind. I'm looking to my left because Valerie Teitel has joined us. Bloomberg's Valerie Teitel with thoughts about the session ahead. I mean, more market reaction to the Middle East, to all of these headlines, I suppose, is in store.
Yeah. And I think if you take into consideration that a lot of the rally in the equity market really started yesterday when Iran's response on those U.S. air bases in Qatar was seen as largely symbolic. So we already had a lot of positivity priced in even before Trump started to talk about this ceasefire, if it is or is not on. So I do think that the equity market does need to see some big confirmation that the ceasefire is over in order to retrace those gains. You know, S&P futures are still solidly in the green this morning, up 0.7%. Very close to all-time highs in terms of the S&P 500 index. So it would need to take, I think, a big signal from Trump that the ceasefire is in peril.
Absolutely. We gapped high first thing. We faded that gap a little bit, but we certainly haven't filled it by any stretch of the imagination. Powell, talk to me about Powell. How hawkish is he going to be? Is he just going to say what he said before?
Look, Powell is going to face a big grilling. He starts his two-day testimony today in front of the House. The big question, I think, for many out there is, do Republican lawmakers sound as combative as the U.S. president in terms of being against the Fed pausing interest rates instead of cutting them? We just had a tweet just an hour ago from the president himself calling for 2 to 3 points of rate cuts. Do we see that kind of pressure from other lawmakers today on Capitol Hill?
All right, Bloomberg's Valerie Teitel walking us through what to expect after what's been a very volatile couple of days. We thank you so much. When you look at these equity markets, though, they are still flying high. We opened, as Guy said, about 2% on the Euro Stoxx 50. We're down at 1%, but still not bad when we're talking about risk sentiment. Oil also retracing its moves. It does it for the opening trade. The Pulse is up next. Stick with us. This is Bloomberg.